Okay, and welcome to day 4 of intermediate macroeconomics. I want to address a couple things before we get into the lecture. First and foremost, I want to say that I completely understand that the first 3 days of lecture has been a lot. That is the nature, of the summer classes, and it certainly makes sense to me that you would feel to some extent overwhelmed by the speed, the sort of material pace. So again, I just want to say that if anybody is running into any, emotional distress, no judgment, reach out to me. Let's have a conversation. The other thing too is that for today's lecture and tomorrow's lectures, Thursday and Friday, my plan is to make it a little bit lighter. And we'll see how I can do that with these particular lectures. And that will be kind of in the week with just a little bit of an ease up in terms of speed, get you ready and able to finish the problem set as well as take the quiz, which is going to be posted tomorrow. So yeah, just, if you missed stuff this week, try to make it up on the weekend. And because, stuff's going to be coming next week. I'm going to try as hard as I can again to make things, sustainable for you. But do let me know if you're running into any issues. All right. So, in many ways, today and tomorrow are the first kind of real macro models that we've talked about. Everything since day 2 has been focused on what we refer to as micro foundations of economics. Now, one of the things that will happen in today's lecture on the classical sort of neoclassical model is the assertion, or I should say, the use of those micro foundations in the context of macroeconomic philosophy, or I should say macroeconomic analysis. Because prior to the sort of neoclassical era, and again, just to give you some time frame here, we typically regard the classical era of economics as 1776 up until around 1890, when Alfred Marshall first publishes Principles of Economics. That, in a sense, introduces microeconomics to the world. There were other economists at the time that were working on similar things to Alfred Marshall. William Jevons is another example of someone who was sort of at the same time as Marshall, starting to think about economic dynamics through the perspective of individual decision making. And of course, this is where you get this idea of marginalism, this idea of sort of thinking on the margin. But ultimately, what's sort of interesting about the sort of transition from classical into neoclassical there at the tail end of the 1890s is that a lot of the macro insights don't really change all that much. Which sort of begs the question, did the development of marginalism, did the development of what we sort of now call the neoclassical model, was it developed sort of too closely related to classical such that it was almost developed so that it produced the same outcomes or produced similar outcomes as to the classical model? That's a little bit of inside baseball, I guess, for economists, but it is sort of something to think about. And again, I think it's very important that we sort of remember that we're thinking about things in terms of simple models. Even if the math gets complex, the models themselves are quite simple. We're certainly giving up some reality to these models. We know that. Then the sort of question becomes, did the development of these models occur in a biased way? I'm not saying that it did, and I'm not saying that it didn't. I'm just saying that it's sort of something to kind of think about, something to stew in your brain. Okay, so what we're going to do is we're going to talk a little bit about the sort of big picture idea in macro. We've already sort of outlined, kind of the basic ideas here. We're going to talk sort of relatively quickly about the classical model, what were the sort of the key ideas from that. And then what we're going to do is in a transition from classical to neoclassical, we're going to talk about the idea of Pareto criterion. That was one of the sort of more important ideas that came out of the sort of neoclassical era, and one of the key differences between classical and the neoclassical model, because there are some differences certainly. And then we'll sort of talk a little bit about some sort of seminal papers and what they have to say about these sort of particular ideas. All right, so in the classical model, these are sort of the core assumptions. Now, it's important to understand that these assumptions are, in a sense, hindsight assumptions. So it wasn't necessarily the case that Adam Smith or David Ricardo were putting these assumptions down before they sort of laid out their particular treatise on economics, but that in hindsight, these are the core assumptions across the classical economists. Rational agents with no money illusion. Now, the concept of money illusion is interesting, because the idea there is that differences in prices can be interpreted as essentially having sort of real value, but at the end of the day, those differences sort of just elucidate pricing differentials, which do not necessarily map to real values, real good values. So one of the things that we're going to kind of grapple with is, how do we think about value? Do we think about it in terms of like the number of apples that were made in an economic system, or do we think about it in terms of the number of apples that were purchased in an economic system? Now, in the classical model, those two things are going to be the same, and in a sense, always going to be the same. So that is a sort of important point. But the extent to which that people perceive nominal values as true values is a key point of the classical model. There's a sense that we can basically ignore prices in the classical model. That's why ultimately you're going to see that there really isn't prices in the classical or neoclassical model. And then later, when we add in the quantity equation, this is where we start to get into prices and inflation and all that very stuff. We have to kind of add in some stuff to that basic classical model. The key insight, I think, of the classical model, and also ends up being the neoclassical model, is that prices and wages are flexible. What this means to our ideas that we've talked about before is that the markets are going to clear. Goods markets are going to clear, capital markets are going to clear, labor markets are going to clear, and that flexibility in prices and wages is especially important when we start thinking about the economy in the sort of short run versus long run. Right now, we're not really putting a time to it. In fact, that's one of the sort of, let's say, main weaknesses of the classical model, is that it didn't really have any kind of time comparison in it. It was just sort of like, this is how the economy is. And that's interesting. That's going to be a big part of kind of what ends up, in a sense, being the main separation between classical, neoclassical, and then the Keynesian ideas. Now, one other quick point we haven't mentioned just yet, but the models that we're discussing, both the classical and then sort of the classical / neoclassical model, right now we're going to close those models. So that means that there's no trade between countries in these models, and that just means there's no net exports. There's no exports, there's no imports. It's just simplification. We will, tomorrow, at the end of kind of one of the last lectures tomorrow, we'll bring in the idea of an open economy. Okay, the big idea and what the things that we were starting to get to yesterday in conversation about the production side or the supply side of the economic system is that we're going to think about things in terms of aggregate. So that micro foundation of the representative firm as being a profit maximizing entity then feeds into this concept of the aggregate production function. So as I mentioned yesterday in lecture, this is why the aggregate production function looks identical to the representative firm. Because the basic idea here is that we sort of understand that there are many different types of firms and many different types of industries, but that at the end of the day, there is in a sense going to be an average production function across all firms with respect to their capital and labor decisions. And again, one of the things I mentioned yesterday that I want to kind of remind you about is this idea of thinking about economies as being capital intense or labor intense. That's interesting, especially when we start talking about the distributional consequences of the classical model, the distributional consequences of the macroeconomy, and then kind of what that might mean for maybe some policy considerations, especially when it comes to taxation and government spending. The A factor here is just that technology factor, total factor of productivity. The cool thing about total factor of productivity is that it's a relatively easy way for us to do country to country differences, because we only really have to kind of decide whether a country is more productive or less productive. And that's, by the way, data we can look up productivity amongst countries. And so we can actually get a sense which countries have high A's and which countries tend to have low A's. Now, the real sort of important sort of insight and kind of speaks to the simplicity of the aggregation of the classical model is that if you go back to the sort of producer problem that we talked about yesterday, the argument is that the producer is going to buy capital up until the point where the rental rate of capital is equal to the value of that addition to capital, what we refer to as the marginal product of capital. Okay, so marginal product of capital is just the addition to my production when I add an additional level of capital. Now, a key insight, or I said a key point, a key assumption of the classical model is that we're going to fix K. The idea here is, again, because there's really no sort of time consideration in the classical model, the idea is that the economy has a particular level of capital. And then businesses are deciding how many employees to hire. So when we sort of move our perspective from the kind of 5,000-foot view of individual firms and then sort of move it to the 30,000-foot view of the entire economy, the mechanism that the classicals sort of used was this idea that capital's fixed and then firms are going to hire employees. And then sort of from that process, the equilibration is that firms will hire employees up to the point where the marginal product of labor, so in the same way that marginal product of capital is the increase in output with respect to an increase in capital, but again, we're going to fix capital, so there's no marginal product of capital, but we're not going to fix labor, and so labor has this marginal product, and then the idea is, again, that firms are essentially going to hire up until the point where the wage they pay their employees, W, is equal to the value of the marginal product of labor, where the value of marginal product of labor is just equal to the marginal product of labor times the price, right? Because so think about it this way. If I get hired and I increase my firm's production by 10 units, then in terms of the value of it, I take the 10 units and multiply it by the price that the product is sold for, and this gives me the value of the marginal product of labor. Then, if I want to think about that wage as a real wage, I simply divide the P over, and what we get is the natural equilibrium condition of the classical model in terms of the labor market, which is that labor will be hired up to the point where marginal product of labor is equal to the real wage. And so graphically, this is sort of what this looks like. So we have a concave production function. This is a well-behaved production function. So going back to our previous lectures about what we sort of would refer to as kind of well-behaved consumption or well-behaved production. So well-behaved production in the sense that there's diminishing returns to labor. So as I increase my labor stock, the actual rate at which that labor stock is converting capital into output is going to decline. It's going to go up. So if I hire more people, if firms hire more people, we expect more production, but we expect the rate of that increase to decline. So this is, the first derivative of the production function is positive. The second derivative of this production function is negative. So it's increasing at a decreasing rate. So we have nice, well-behaved production functions. And then the idea here is, let's imagine a world in which there's an increase in total factor productivity. So here we see that A is increased, and because A increased, we now have a higher production function. So then the question sort of comes to us, which is that what is this going to do in terms of the macroeconomy? Well, the classical model argues is that if there's an increase in total factor productivity, this is going to correspond to an increase in the demand for labor, right? So basically, as the productivity of the economy increases, as the economy becomes more productive, we expect there to be higher demand for labor as a result. Now, the other thing that happens is that if the production function rises, then for any given unit of labor, the marginal product of labor is now going to be higher, right? So think about this. If I just look at this L0 here, and I go up and I consider the slopes of these two production functions, so at point A and point C, what I should notice is that in sort of comparison, the slope at C is higher than the slope at A. So what this means is that not when we say we are more productive, we mean that the increase in output with respect to labor increases. So the marginal product of labor increases. And so because the marginal product of labor has increased, this causes firms to want to demand more labor because labor has now become more valuable to profit maximizers, right? And so the nice thing about this from the labor side is that this sort of helps us to understand increases in real wages, right? So the idea would be is if the economy becomes more productive, labor demand shifts out, this is going to correspond, all else equal, to an increase in real wages potentially, right? So that's kind of sort of step one. Then we think about this in terms of both the supply and the demand for labor, and we make the assumption that the labor market equilibrates, right? We have market clearing. So there's going to be an equilibration at point E. So the real wage in the economy is here, W divided by P over E. And then the idea here is that this real wage is going to generate a labor force, right? Because remember, go back to the labor leisure model that we talked about in yesterday's lecture, right? The idea is that if wages rise, now people are likely to respond to working more because the value of working more has increased to them, right? That's sort of the sort of neoclassical idea of the labor leisure trade-off. So that LT here is the entire labor force, and the W divided by P here, real wage, would suggest that there are people willing to work at that wage, right? If the wage goes up, there's going to be more people willing to work at that wage. If it goes down, so on and so forth. So the idea here is that the production side of the economy causes the labor market to equilibrate with respect to real wages, with the extent of the increase in real wages being caused by an increase in total factor productivity, increasing labor demand, and then also, of course, subsequently increasing labor supply via the labor force. So again, labor market completely clears. So this means that the real wage will move either up or down until the demand for labor is exactly equal to the supply of labor. So what this means from the classical neoclassical model is that we assume full employment. The idea of full employment is that there is no cyclical unemployment, essentially. That wherever the economy is, since the labor market's always going to clear, wherever the economy is, the labor market has cleared at that place, that is going to be full employment. Okay, so you start to kind of see a little bit about why the classical neoclassical ideas did not favor government intervention. Because if you assume that labor markets are always clearing, then what's going to happen is if there's some change in your underlying economy, it's going to immediately be reflected in a rebalancing of real wages in the labor market. So in a sense, the labor market ensures the equilibrium in the rest of the economy. And because we assume the labor market always clears, in a sense, this means the rest of the economy always clears as well. So the classical neoclassical model would argue that wherever we are currently, that is full employment. So even if unemployment's 10%, the classical would argue, well, that's still full employment. The economy is just producing only 90% employment, right? As opposed to nowadays, we tend to think about full employment being a number rather than an idea. The number being sort of 4 to 5%, or really nowadays kind of 3.5 to 4.5%. But the idea was full employment used to be more of an idea, that the economy was always at full employment because the economy was always in equilibrium. So this sort of is interesting because what it then argues is that the basis of demand is supply, right? Because the basis of labor wages is the marginal product of labor relative to the production function. So relative to the supply of goods, that determines wages, real wages that people receive. Well, the real wages that people receive determine, of course, the willingness to supply labor to the economy. And then, of course, when people supply labor to the economy, they get wages back, which then creates demand in the economic system. That's the classical idea. That's Say's law. Supply creates demand. Because firms are producing goods, they demand a certain amount of labor. Because demand for labor generates a real wage, and if demand for labor increases, real wages rise. This generates a supply of labor, right? Think about yesterday's lecture. We start with production, we go into investment, we end with labor supply. Because in the classical model, that's sort of the way it works. You produce, you invest, that generates conditions for hiring employees. When you hire employees, you pay them wages, they turn around and demand goods and services. Supply creates demand. Now, the net result of this also, that supply creates demand, is that we have the classic supply equals investment in our economic system, where now the mechanism of equilibration is that interest rate, right? Again, go back to the consumption lecture, go back to the production lecture. The interest rate has always loomed large, right? The interest rate causes behavioral changes in consumers. Interest rates changes cause behavioral responses in producers. And the idea in the classical model, and which will also be true in the neoclassical model, is that the savings in your economic system, the lack of consumption in your economic system is going to generate the liquidity available to lending institutions for those capital investments that we expect businesses to make. But the mechanism is still, the whole point of businesses making investments is because they want to increase their ability to produce. And if they are able to increase their ability to produce, this is going to increase labor demand. It's going to increase wages. And if we make an assumption that essentially savings rates are pretty similar across consumers, then any kind of increase in wages across the economy is also going to generate an increase in savings about the economy. So then you're going to get this increased liquidity supply. There's going to be more available loans for capital investment from consumers. So you can just sort of see that circular flow. Even if we put investment in there, you can see that investment is triggered by firms wanting to make higher profits. The only way that firms can make higher profits in the competitive market is by being more productive. And by being more productive, this allows them to pay higher wages, people get consumption. That's the classical model. That's the circular flow. All right. So this is Say's law in sort of graphical representation. So this is just the market for loanable funds. We'll talk more about that in a moment. And then the idea here, for example, is that let's say the supply of loanable funds increases, and if the supply of loanable funds, if savings increases, then this, for example, is going to put downward pressure on interest rates. And so then the response of downward pressure on interest rates is going to be increased investment. So savings increases, downward pressure on interest rates increases investment. If the opposite happens, if savings goes down, then investment's going to go down, in part because interest rates have gone up, right? That's the equilibrating feature of Say's law. Supply creates demand, and the reason why supply creates demand is because in their pursuit of increasing supply, firms will undertake investment, capital investment. The extent to which they can undertake capital investment will be determined by the level of savings. And the only way to increase the level of savings is for people to increase their wages. And the only way for wages to increase is if the economy becomes more productive. That's the classical model. So I think we'll stop there for this particular lecture, keep this one a little bit shorter, just to kind of give you sort of the idea here of the main kind of classical model. What I'm going to do is, for now, I'm going to skip the quantity theory, and then we're going to bring that back when we discuss the sort of neoclassical additions to this. So we'll stop this lecture here on the classical model. But real quick, let's just kind of look here. Ignore money neutrality for right now. We're gonna bring this idea back. So here's the key ideas of the classical model. We have market clearing. We have Say's law. The economy is always in full employment, always. Which that non-cyclical unemployment is going to be a huge part of the Keynesian disagreement. And then the interest rate mechanism is what ensures savings is always equal to investment, right? Again, think about it for a second. If the level of savings is greater than the level of investment, right? Think about this in the context of, in the goods market, what happens if there's a surplus of goods? The price is going to fall. So if there's a surplus of savings, the interest rate has to fall. If there's a shortage of a good, we expect the price to rise. If there's a shortage of savings relative to investment, the interest rate has to rise to equilibrate it. So again, the sort of reliance upon neoclassical supply and demand looms large in the classical model. So that's why we kind of refer to it as classical / neoclassical.